Access show notes and learn about our English courses for economists by visiting our website, englishforeconomists.com. Hello and welcome. I am Alan Robert and I am your host at English for Economists. I specialize in teaching English to economists. I love what I do and I am so very happy that you could join me today. My goal with these podcasts is to present you with practical, non-technical vocabulary that you can use to talk about many different areas of the economy. This is podcast number 2, and today our topic is mortgage loans. It's an important topic after all, since mortgage loans are popular worldwide. For example, did you know that the global mortgage market is estimated to be more than $6.5 trillion US? It's quite possible that you or someone in your family has a mortgage. Mortgages can be a solution for helping people buy their own home. But if the market is not well supervised, it can lead to a financial crisis. So mortgages are important on a micro level, and they're important on a macro level. So let's get started with the vocabulary. Listen to these words and expressions along with their definitions. You will hear them used later in context, and I'll repeat them again at the end. The first word, or really 2 words, is down payment. Down payment. This is the initial payment made when something, for example, a house, is bought using credit. Down payment. Mortgager. The borrower in a mortgage, usually a homeowner. That's the mortgager. Mortgagee. The mortgagee is the lender in a mortgage. Usually it's a bank or another kind of financial institution. Purchase outright. That means to buy in one payment without borrowing money. To purchase outright. Pledge. To pledge is to make a legal commitment to give a security on a loan. To pledge. Delinquent loan. Well, that's a situation where a borrower is late or overdue on a payment. A delinquent loan. They are delinquent with their payments. Foreclosure. Well, that's the action of taking possession of a mortgaged property when the borrower fails to keep up their mortgage payments. The bank or the financial institution will foreclose on the mortgage. Foreclosure. Repossession. Well, repossession is the action of retaking the possession of something, in particular when a buyer defaults on payments. So if somebody becomes delinquent with their loan, the bank will repossess the property. Amortization. Well, that's the action of paying off debt with regular payments. Now, you've probably heard the word mortgage used before, and you already understand that a mortgage is a type of loan that people will get from a bank or another type of financial institution, which they use to buy residential property, like a house or an apartment, or maybe a piece of commercial property, like a store or a warehouse, for example. Now, mortgage loans definitely fill a need. People and businesses usually take a mortgage loan because they don't have enough savings to purchase the property outright. Now, the length of most mortgages varies from 10 to 30 years. Over this period, the loan is slowly repaid through a process called amortization, which usually consists of regular monthly payments. There are two important characteristics to mortgage loans. The first is that the lender, who is also known as the mortgagee, usually requires the borrower to make a down payment. In other words, the buyer, who is the mortgager, needs to pay part of the total price of the cost of the property. Typically, this amount represents 10% or 20% of the total cost, but that amount can vary. Having buyers, remember the buyer is the mortgager, commit some of their own money helps prevent irresponsible purchases. The other important characteristic of a mortgage loan is that borrowers pledge their right to the property as a guarantee for the loan. In other words, the borrowers promise to surrender their right to the property if they can't make payments, so the lender can take legal possession of the property, remove the occupants, and sell it. So to put that another way, if the borrower doesn't make all of the payments as promised, the loan becomes delinquent, and the lender can foreclose on the property, repossess the property, and then sell the property to recuperate the money. All right, friends, before we finish, let's just pass over the vocabulary one more time. We saw that a down payment is an initial payment. Down payment. Mortgager. That's the borrower. Mortgager. Mortgagee. That's the lender in a mortgage. Mortgagee, the lender. Purchase outright. To buy in one payment. To purchase outright. Pledge. Pledge. To offer the property as security, to pledge. Delinquent loan? Well, that's the unfortunate situation where a borrower is overdue with payments. Foreclosure. To take legal possession of a mortgage property when the borrower doesn't make the payments. So the banks foreclose on the property. Repossession. To take back the property in order to sell it. So they will repossess and physically take back the property and sell it to recuperate the money that they lent. Amortization, that's the period in which a debt is reduced or paid off by regular payments. That's all for today. The English for Economists podcast is new. So this is a good time to share it with your friends and colleagues. They will thank you. Also, if you have any suggestions or comments, please write to me at alan@englishforeconomists.com. You can also go to the webpage and find a contact form there. I would very much enjoy hearing from you. So, until next time, this is Alan Robert at English for Economists, wishing you a fantastic day. Take care.